We now continue our discussion on equity valuation unit 3, and in this particular video we are going to look at this ratio called price to sales, right? So price to sales is another one of the price metrics that we look at, and we're going to look at when is it useful, how is it calculated, and what are the possible issues when we're using something like price to sales as a ratio, right? So what is typically price to sales ratio? It's simply market price divided by sales per share, or the simpler way to calculate it is the market cap of the company divided by the sales revenue of the company, right? So what is the market cap? That's the price per share into number of shares, and you divide it by the revenue of the company. As per uniformity principle, you can take net revenue, you can take gross revenue, you can take total revenue, whatever you want to take, you take that. But you have to use the same for all sets of companies that you're working with, right? So whatever you're using, everywhere either use net or gross or total, right? So that's basically the uniformity principle that comes in price to sales. Fairly straightforward ratio. There isn't any major calculation that needs to be done. As long as we can find the market cap and the sales revenue, we can immediately find the answer to that, right? Now, where is it useful? It's primarily useful where earnings are negative, and even book value is not representative of the business fundamentals, right? We've already seen that if earnings were not negative, we would have used price to earnings. If book value was representative, we could have used price to book value. But if both of them are not representative, in those specific cases, price to sales becomes very important, right? Some firms may have resorted to huge capex in terms of real estate development, and the might be making losses for the first few years. A PE will give a distorted picture, while even P by B may not be able to capture the complete value. So, for example, for retail companies, sales is the most important criteria. They want to try and gain market share in the first few years of operations. So you're going to try and evaluate these companies based on what is the sales that they're doing at this point of time. That's how, let's say, if there was a retail firm that was going to acquire another retail firm, the target company may not be profitable at this point of time. You don't know whether it is profitable or not, right? So how does the acquisition work? Other than the fact that you have some sense of what is the market share of the company, and that market share is determined by the sales bit. So effectively, sales or price to sales becomes important because sales gives you an input into the market share of the company, right? The bigger positive here is that it can be calculated for all firms and it's not biased. Why is it calculated for all firms? Because you cannot have negative sales. Negative sales is not a possibility. You don't give money to people to take your product or service, right? Typically, you will have zero sales or positive sales. So that's simple, and hence the average is not skewed, unlike the PE by PB, PE or PB, where the denominator can be negative, and those firms are not really included in the average properly, right? The only firms that miss out here are those who do not have clearly defined revenues or which have zero revenues for a while, right? Your guys like R&D firms or startups or banks which have not recorded any revenues, or banks basically because the revenue calculation for banks is a little bit tricky, right? Banks give out loans and they earn interest on those loans. So theoretically, the bank is trying to sell a loan, but it's the interest that is the income for the bank. So sales calculation is a little bit tricky. In which case, you typically look at this in the context of companies where market share is important, companies where revenues are where profitability is not there, but revenues give you an idea about what the scale and size of the company is. That's where primarily price to sales ratio will get used, right? So that's about the ratio. There is a problem, however, and the problem, if you remember, in terms of the consistency premise, is that both the numerator and denominator need to apply to the same set of stakeholders. It should apply to the same stakeholders. Now, in price to sales, the problem is price applies to the equity guys, but sales is for both the equity and debt guys, right? Sales is for both the equity and debt guys, because from sales you will get EBITDA and EBIT, from which both interest and net profit would come out, right? Now, what is the problem with that? Let's try and consider this. Let's say there are two firms A and B, and the price to sales ratio of both these firms is, let's say, 4, right? Now, they're in the same industry, so they are same industry, and let's say they are sort of similar firms as of now. In terms of our interpretation, price to sales will have similar interpretation to price to earnings and price to book, which is essentially lower the better, because you are giving a lesser market value for the same sales. So if two companies have sales of 100 crore each, and one has a market cap of 200 and another has a market cap of 300, you would want to buy the first firm, because for the same 100 crore worth of sales, you are paying lesser, correct? So that's the standard premise that you're looking at. Now, because they are same and similar industry, they probably traded the same price to book value. Now, let's say firm B decides to raise debt, and let's say lots of it, right? Lots of debt is raised. All this debt is used in sort of marketing, and that basically increases sales but not profits, right? Profits are not increased. Sales are increased, but profits are not increased. Once you increase the sales but not the profits, what that does essentially is there are two things that will happen when you calculate price to sales ratio. For A, there is no change. For B, in price by sales, sales goes up. Sales goes up because we've increased sales, taking a lot of debt, right? And once we take a lot of debt, the other thing that starts happening is the risk goes up. So with this, the risk of the company goes up. So the market will resort in terms of reducing the price, right? So the price goes down, sales goes up, so price to sales ratio on its totality is going to go down dramatically. So maybe this ratio becomes 2 after this entire activity. Now, once this ratio becomes 2 after this entire activity, based on our earlier premise on lower the better, if I don't really look at all other things and I only look at this ratio, I'm going to choose firm B for investment. And that is going to be the incorrect decision, because this firm has increased its sales due to higher debt, and its price has fallen because of the higher perceived risk in this, because of the higher debt. So theoretically, it makes sense to buy company B, but practically speaking, this is going to be incorrect. And why is because there is a lot of risk, and the price to sales is probably lower to reflect that risk, right? So once again, the question that comes to our mind is, why does price to sales appear where it appears? And that becomes an important discussion in our overall understanding of a metric like price to sales, right? So it is an inconsistent ratio because the numerator only shows equity and the denominator shows equity plus debt. If we had a numerator that instead of equity showed equity plus debt, then equity value would have gone down because of higher debt, but debt value would have gone up. So the numerator would have remained stable, right? So the distortion would not have been as big as we see in price to sales. We will look at a ratio that might help us solve this scenario, but at this point of time, it suffices to say that price to sales does not work in all sectors, especially sectors where there is lots of debt, right? So remember the consistency premise. Sales belongs to all stakeholders, making price to sales an inconsistent ratio, especially when firms take larger debts. Price to sales ratio can get distorted as price of the share falls because of the rise in debt, and the firm starts appearing undervalued. We will understand a ratio called EV by sales, enterprise value to sales, which is going to be a better indicator. So in the next section, we're going to discuss the enterprise value ratios and understand why that basically solves this problem, right? However, this is used for firms where either debt equity remains constant or close to zero, which is technology firms, for example, have very low debt equity, or it is used in sectors. So what are the sectors where you will use this? Either sectors which have zero debt or stable debt, or you are using it in for startups where you don't have any other measure. So whether we like it or not, we are going to use it, or you're going to use it for companies where market share is an important yardstick, right? So retail sector, for example, where you're trying to figure out what is the market share, right? While it is inconsistently defined, it still remains a widely used indicator. The distribution is smooth. Unlike the PE and PB, where you could have wide variations across firms and sectors, price to sales is relatively less volatile. And there's no typical price to sales that applies to specific sectors, but the distribution is smooth. There is no negative values here, so that makes life slightly simpler for us in terms of our calculations, and that's basically how we look at the price to sales ratio, right? So typically you will find companies with zero debt, stable debt, startups, or market share being very important, which is going to use your price to sales ratio as we look at it. Let's try and calculate this for a few companies. We already know Infosys market cap is 234,000. Can we calculate the sales of Infosys? What was the sales of Infosys in the last year? So if we go back to our Infosys model and we go back to the P&L and we look at the sales for last year, that's about 62,000 crore of sales in the last year. So I can take this number and divide it by 62,400 odd crore, which will again give a number of somewhere close to 3.8 to 3.9 times sales, right? That's the price to book for Infosys. Let's do that for another firm, Ultratech Cement. Now, how do I find the market cap for Ultratech Cement? I can either do a Google, or I could go to the Money Control website and search for Ultratech Cement. That's Ultratech Cement. We can click on Ultratech Cement. We go here, and as you move lower on this page, you will see the market cap given to you. That's the market capitalization for Ultratech Cement. 104,348 is what you see as the market cap for Ultratech Cement. 104,348 is the market cap for Ultratech Cement. So I can point it down as 104,348 is the market capitalization. Let's go back and try and find what is the financials of this company. So this gives us the financial data, and I can click on profit and loss in this, and I can click on consolidated in this. Consolidated is important because we're going to look at major data, and about 28,000 crore is the sales data, right? 28,000 crore is the gross sales, or net sales is 25,000 crore. I can use any of these metrics. Let's use 28,000 crore. And when we do this, 28,000 crore, if we divide, this would probably be somewhere around 3.6 or so, right? Approximately 3.6 or so would be the number. 3.6, 3.7 would be the price to sales number. So that basically is how we go about trying to calculate price to sales. It's fairly straightforward. I have to find the market cap and divide it by the sales. The only thing I need to consider is whether I take gross, net, or total. I need to use that uniformly across all the companies that we're looking at, right? That's a simple calculation. Try and do this for your firms under consideration. Price to sales ratio calculation. Remember, useful in sectors which have zero debt, stable debt, startups where sales is the only parameter which is available, and market share is important, such as retail sector. It is fundamentally an inconsistent ratio. So firms which will have larger debts will see this number getting distorted, right? So you don't use it in firms where, like infrastructure or capital goods, where debt is huge. You use a variant of this that's called enterprise value to sales. That's we look at it, right? So that's broadly it in this particular video. Quick couple of questions. Why is price to sales ratio considered as inconsistent? Give an example to show that. Which sectors do we usually calculate the price to sales ratio for? Thank you.